As we have mentioned before in other videos, the primary equation used in the accounting process is known as the accounting equation. The accounting equation is assets equal liabilities plus stockholders' equity. We use this accounting equation in our accounting information system to collect, process, and communicate information to those decision makers. In order to apply the accounting equation to the activities of a company, you must determine whether the activity was a transaction. A transaction is an economic event that has an effect on the financial statements. Not all events are transactions. However, all transactions are events. So when we look at an activity of the company, we have to ask the question, does it make a change to the assets, liabilities, or stockholders' equity of the company? The important thing in any equation is that there is a dual effect. In other words, if there's a change in the assets of the company, something should happen on the other side of the equal sign to the liabilities or stockholders' equity. At all times, the accounting equation must remain equal. So what we need to do is when we take a look at accounting transactions, we have to ask ourselves about the event is that will it affect the financial statements? So for instance, if I purchase a computer, I know I'm purchasing the computer and I'm either using cash, an asset, or I'm using credit, a liability. In return for that cash or credit, I receive an asset of equipment of being the computer. So, because of that event, I'm going to record the purchase of the computer. If I'm going to talk to one of my customers to talk about something, that might be an event, but it really doesn't have an effect on my financial statements. The mere fact that I'm talking to a customer does not increase or change my assets, my liabilities, or equity, so therefore I'm not going to record that event. If I pay rent, I'm going to normally pay rent with cash, so my cash is going to decrease, and I'm going to take the benefit of using that building that I'm renting, so I'm going to have rent expense. So what I've got is an decrease to cash, my assets, but I also decrease my stockholders' equity. So when we look at the accounting equation of assets equal liabilities plus stockholders' equity, we can apply all transactions to these three categories. But we need to take into further account the detail that falls under the stockholders' equity section. Within stockholders' equity, we have common stock and retained earnings. And we've spoken about this in prior recordings, that retained earnings are the earnings or profits of the company that have not been redistributed back to the shareholders. In order to determine what retained earnings, we had a formula of beginning retained earnings plus net income minus dividends, which would give us the ending retained earnings. Net income was determined by taking revenues and subtracting out all the expenses. So what we can do now is, if we have the original accounting equation of assets equal liabilities plus stockholders' equity, we can take the details of each of the various transactions and apply them to the accounting equation. So let's take a look at this event. On October 1st, cash of $10,000 is invested in Sierra Corporation by investors in exchange for $10,000 of common stock. Since we received $10,000 in cash, cash is going to increase. So note under the cash column an increase of $10,000. In exchange, on the other side of the equal sign, Common stock is going to increase by $10,000 because we want to recognize how much money the investor had invested in the company. Next, event number 2 on October 1st, Sierra borrows $5,000 from Castle Bank by signing a 3-month, 12%, $5,000 note payable. By borrowing $5,000, cash is being increased by $5,000. On the other side of the equal sign, we signed a note, which is an obligation to pay the bank back the $5,000. So therefore, we need to show that our liability called notes payable has been increased by $5,000. Event number 3, on October 2nd, Sierra purchased equipment by paying $5,000 cash to Superior Equipment Sales Company. So, if we're paying out cash, cash is being decreased by $5,000. So note under the cash column, transaction number 3, decreased cash by $5,000. In exchange for that $5,000, we receive $5,000 worth of equipment. Equipment is increased by the $5,000. Note that there is no transaction on the other side of the equal sign because all the activity occurred within the assets side of the accounting equation. Transaction 4, on October 2nd, Sierra receives $1,200 of cash advance from R. Knox, a client. So what's happened here is that we've received $1,200 in cash, so cash has been increased by that amount. Now the question is what's the other side of the transaction? Because we've received the cash in advance and we are following the accrual accounting principle of revenue recognition of when we earn it, we need to recognize that the $1,200 is a liability, not revenue. We've received the cash, but we haven't earned the revenue yet. Once we do the work, we will take the money out of the unearned revenue account, the liability, and recognize that we've earned revenues. On event number 5, on October 3rd, Sierra receives $10,000 in cash from Copa Company for guided services performed. Note, in this event, we've actually performed a service, so we've therefore have earned the revenue. So cash goes up on the asset side by $10,000, but the revenue increases by $10,000 over on the retained earnings. Event number 6, on October 3rd, Sierra Corporation paid its office rent for the month of October of $900. So cash goes down by $900 and the expenses are going to decrease retained earnings. Now be very careful with this because I find that many students will want to put a positive number in this column. If an increase in expenses occurs, we're going to show a negative sign there because it's not that the expenses decrease, it's that the retained earnings and stockholders' equity decreased. That's the reason why we show a minus sign on the $900. Event 7, on October 4th, Sierra paid $600 for a 1-year insurance policy that will expire next year on September 30th. Now, remember what we talked about the matching principle. The matching principle said we want to recognize expenses in the same period that we earn the revenue, or we recognize the expenses when we receive the benefit of the payment. So, if I've spent $600 for a 1-year insurance policy, I'm going to receive the benefit of the insurance every month for the next year. So, In essence, what I have done is I have prepaid for my insurance. So I show in the cash column that cash went down by $600, but I've increased an asset called prepaid insurance. Once each month occurs, we're going to reduce the $600 by 1/12 and recognize that we've had insurance expense as we've gone through each month. Event number 8. On October 5th, Sierra purchased an estimated 3 months of supplies on account from Aero Supply for $2,500. The key thing here is that we didn't pay cash, we used credit. Whenever you see the word on account, you know that you've had a credit transaction. So because of that, we owe $2,500 to Aero Supplies. In exchange for that, we receive supplies that will take a while to use up. So we don't recognize it as an expense because we haven't used it for the normal operations of the company. We're going to be using it later. So we recognize it that it's an asset. The next event, on October 9th, Sierra hired 4 new employees to begin work on October 15th. The event of hiring an employee does not affect the financial statements. The employees haven't done any work yet. All they've been is hired. Once they perform services to the company, then the company owes the money. But just the mere fact of being hired, we do not recognize the transaction. Event number 10, on October 20th, Sierra paid a $500 dividend. A dividend paid in cash is going to decrease our cash account. Also, remember in our retained earnings equation, dividends decrease retained earnings. That's the reason why you see a negative $500 under the dividends column. Our final event is event number 11. Employees have worked 2 weeks earning $4,000 in salaries, which were paid on October 26. This transaction occurs in the month of October, and we decrease cash by the $4,000 because that's the amount that was paid out. Also, we recognize salaries expense in the expense column, and we decrease retained earnings for the $4,000. Once we've recognized all the events as accounting transactions, we can total up the columns and then accumulate all the asset columns and compare them to the liabilities plus stockholders' equity columns. If I was to add all the assets together, I come up with $23,300. If I take all the liabilities and stockholders' equity accounts, we come up with the same value. So we know that we have posted the transactions to our worksheet properly so that we make sure that we can now create a financial statement. As you look at these numbers, one of the things that should stand out to you is that it's very important to make sure that we classify transactions correctly. In your textbook, we ask the question, why is accuracy important? It's very important that we categorize the transaction into correct categories because we want to make sure that we tell the reader of the financial statement exactly what happened. Even though the assets equal liabilities plus stockholders' equity equation could stay in balance because we increase or decrease both sides of the equal sign, we still want to make sure that we put the dollar amounts in the right categories so that we can properly report the activities of the company.